Sabrina, we have been investing in industrial properties since the inception of the firm 35 years ago, and we've had a lot of experience in that, and we've seen just massive growth in the demand for industrial properties throughout the country. Why don't you give our investors a little background in terms of what's driving this and what are the characteristics of that demand?
Absolutely. I think what everyone sort of expects is the answer, and it's true, is it's largely being driven by e-commerce. So fundamentally, distributing goods from a warehouse is different than sending it via the store, and a lot of retailers have had to up the amount of space they have to occupy in order to service same day and next day delivery, and it's really been insatiable demand by those tenants.
When you're talking about industrial, we break it down into logistics, then we go into last mile. Let's talk a little bit about last mile in terms of what that really means to investors. I mean, when we're explaining that, how should we be thinking of that?
Last mile has really become this buzzy word that everyone that's trying to sell an older industrial building uses in their marketing packages. The reality is that last mile is really the last touch point between the distribution and the end user. So whether that's coming to your house via an Amazon package, if the last mile is from the warehouse to a store or a business. And so what's of course funny about that is it's not really a mile. It can be 5 miles, it can be 15 minutes, it can be half an hour. And so the definition of last mile in a given market can vary materially. Now what we're talking about in terms of physical structures is often older product because that's what exists in truly infill locations. So when we think about cities like Los Angeles or New York, we're trying to get as close to the rooftops as possible. We're trying to cut down on the transport costs that our occupiers are paying in order to distribute goods, and they're willing to pay higher rents in order to be closer. So that's really what we're talking about when we say a last mile facility.
So you and I, when we talked the other day, we were chatting about the fact that I ordered something and I expected it to be delivered 20 minutes later, and everybody was laughing about that. But isn't that really the consumer issue? The demand side of the equation is expecting more and more speed with respect to that. Is that what we're thinking about when we think about last mile as well?
Absolutely. If you look over time, the expectation was, call it 5 or 10 years ago, that if you got something that you ordered online in 2 to 3 days, that was really fast. Fast forward to the pandemic, we wanted things the next day and same day, and now occupiers are trying to get ahead of those consumer demands and be able to deliver within an hour or 20-minute window. And again, that really forces occupiers to get as close to their end user as possible.
So you had mentioned earlier about the fact that rents are going up. I mean, the fact is that rents are in fact going up, and they're going up at an exponential rate. Should we be concerned about that? Is that getting to the point where the cost of an industrial building is more than the cost of an office building in urban areas?
I think what you're implying is that the value of offices would have to go down quite a bit and the values of industrial would have to increase quite a bit. I think we're quite a ways away from tipping that equilibrium point. But what I will say in terms of rent growth is that the demand has really just been insatiable, and anybody that has lived through several industrial cycles, we continue to expect that supply will eventually overtake demand and begin to moderate rent growth. We're now 9 years into this industrial bull run, and to date, we really haven't seen any pockets where supply is overreaching demand. And so again, so long as those conditions exist, we'll continue to see very robust rent growth.
Are you concerned about the fact that rent growth is going to result in additional development in urban areas next to houses where the community starts to react negatively to this?
I think for that to happen, there has to be space to be able to be developed. And so when we think about a lot of cities or dense municipalities, there really isn't the space to be able to develop those buildings. You may start to see pushback from communities that don't want these facilities in their backyard. As investors and communities start to focus more on ESG, they might become focused on the amount of truck traffic or emissions that are coming out of these. And so what that could mean is actually less supply going forward in aggregate, but that also suggests higher rent growth because the demand is not suddenly going to dissipate.
So what impact has COVID had in terms of this entire conversation?
I would say that it has accelerated the demand for industrial. You know, if you look at e-commerce as a percent of total retail sales, it really spiked early in the pandemic. So during lockdowns, people that maybe otherwise had never purchased goods online or only a few times a year were suddenly relying exclusively on these retailers to be able to order online, have things delivered safely, avoid the grocery store. And while we've seen that e-commerce penetration rate normalize a little bit, it's still above what the pre-pandemic trend line would have been. So we've experienced an acceleration and almost a bring forward of that e-commerce demand by virtue of the pandemic. So it's one of the few sectors that has actually benefited from the environment.
So at the beginning of the pandemic, you and I were chatting about with some of our investors the whole issue of onshoring and supply chain mismanagement and just the disruption that existed out there. What do you think about the idea of onshoring and how accelerated do you think that is actually becoming? Is this hyperbole or do you think it's real?
You know, I think anecdotally, you are seeing certain companies bring parts of their manufacturing back to the United States. Now, whether that's by virtue of supply chain delays, they're just not able to get their goods fast enough, so they're making large capital commitments to be able to manufacture parts of their products here in the United States. The reality is that globalization occurred over several decades, and it was a very thoughtful approach. It combined the cost of labor, how long it takes to get goods, and so it's not easily reversed and it's not quickly reversed. So while we may see a gradual reshoring of certain parts of the manufacturing supply chain, I do continue to think that globalization remains supreme in that regard.
So let's pivot a little bit to the whole issue of the ability of the manufacturers and the logistics users to be able to get labor and their rising costs that are associated with this, and this shift of technology to robotics and other alternatives that are there. How would you evaluate that within the landscape of industrial utilization? Does that enhance the ability to be, should we be buying more of this, or should we be thinking of this as a negative?
You know, I think a lot of industries, including warehousing, have faced labor shortages, particularly during the pandemic. People don't want to be working close together. You know, if people get sick, there are people who miss shifts. And so that's a real challenge for the warehouse space. The reality is that robotics as a penetration is still very low in warehouse. It's less than 10% of warehouses have really deployed automation. So there's a huge upside for companies to be able to leverage that incrementally. What's prevented them from doing that thus far, at least historically, has been there was ample labor availability and there was not a huge incentive to implement technological advancements to offset that. Now I think you're going to see an acceleration of technology adoption to offset this tight labor market. So ultimately, I think there might be a little bit of a pain point in the near term as companies adjust and figure out their spending, but that technology can help supplement what they're not getting in the traditional labor force, and so that may ease some of their constraints as far as what markets they may be willing to go into.
Let me just shift to the final question here, which is the value proposition in terms of increasing values of industrial, primarily driven by declining cap rates and increasing rents. Operating off of each other. Where do you think that values are going? Because in 2021, we had the highest return I think I've ever seen in terms of industrial. Do you expect that to go on for the next 2, 3, 4 years?
You know, I think what we saw in 2021 was just astounding. And as you said, it was a record-breaking year for total returns for the industrial sector. We do expect those returns to moderate, but still be far and above the strongest property type in terms of unlevered returns. And so for this year, right now our expectation is for total returns to surpass 20% again. So another very, very strong year for industrial.
Do you think that there's an opportunity in suburban office, the traditional 1960s, 70s, 80s, 3-story, 2-story where office building being converted into multi-story warehouse and multi-story logistics? Do you think there's a play there from a value standpoint?
I don't. I think what you would see in terms of multi-story development is a select number of markets where land values have become so expensive that you have to go up instead of out. but there are a lot of technical elements that make multi-story warehouses somewhat more challenging for users to use, get used to. They have to learn how to operate in these spaces because it's relatively new in the United States. And so to take an existing building that was built for another purpose and try to repurpose it for multi-story, I think you'd be very challenged to have that functionality. You'd probably be better off just trying to actually build a multi-story warehouse from scratch.
Okay, great. Thank you.